Firstly, with the FRTB compliance deadline being delayed to January 2022, is FRTB a priority for banks?
It's a really good question. So many firms will take a potentially relaxed view. They have longer to implement it. But for any firm that is serious around FRTB, absolutely. It's still on the agenda and it's still a priority. And the real reason for that is the fact that it takes up much more time to implement these kind of changes than you'd expect. And actually, the deadline isn't as long as you would imagine. So if we break it down into individual components, what have we got? Well, let's roll all the way back. So if we go back a couple of years in January 2016, and FRTB first came out, we had a compliance deadline of December 2019. So we had about 4 years. Over the course of 2016 and 2017, the individual regulators chose to postpone the compliance deadline of FRTB. And so bit by bit, first we had the Europeans, you had Australia, you had the Canadians, and one by one, each of the regulators chose to delay FRTB. And as each of them chose to delay FRTB by at least a year, it then brought into the key question, when does FRTB actually come into effect? When should a bank be ready? And so with that in mind, in 2017, in December, the BCBS, who are the Basel standards and the key regulator here, then revised the deadlines. And so then they revised deadlines to January 2022. Now, with the revised deadlines, you're saying, hey, we've got more time. What are we going to do? And for a bank which is just doing standardized approach, it's probably not unduly challenging to implement FRTB on time. And they probably can be a little more relaxed. But for those banks that are looking for IMA approval, they have to go through processes of refining their methodology. So what do I do about implementing expected shortfall? They have to go through and align their middle office and their front office systems. It's a big piece of work for some institutions. And then they need to go through the process of actually implementing a solution for NMRF requirements, which again, something completely new they haven't done. So with all that in mind, there's an awful lot of work to do. And 3 3/4 years may not sound like it's a particularly challenging deadline, but the sheer quantity of work means that actually it can be challenging. Now, on top of that, this isn't like a MiFID deadline, or this isn't a conduct regulation, this is a prudential regulation. And the key difference with prudential regulation is the fact that you need to be ready in advance of the deadline. And so in some jurisdictions, you may have parallel runs. So you may need 12 months worth of data before you get to January 2022. And in addition to that, in some jurisdictions, there may be observation periods. So your 3 years or 3 and a bit years quickly becomes shorter and shorter time allocated to actual implementation and more time to observing. That's why it's still a priority for 2018 and 2019.
And what advice would you give to any bank implementing an NMRF solution?
The key requirement here is actually around the process of collecting executed trade and committed quote data. And many firms have started that process by coming up with hypotheses over where they think the challenges are going to be. And those challenges aren't always where you would expect. So at Thomson Reuters, we have commenced a process of collecting a data set and analysing that to see what trends that we could find. So the recommendations and feedback I provide are based on this data set. So just to set the scene, we collected a data set which is based on, firstly, OTC data. So we wanted to replicate the kind of areas where there'd be a challenge. We've used multiple sources of data. So this isn't just a single data set, this is multiple sets of data combined together into one cleansed and processed data set. And it also is designed to represent those instruments that are more challenging or likely to be more challenging to pass the compliance test. And as we looked at that data set, we started to understand what was going on in the real world. And that gave rise to some really interesting themes or topics that we identified. And those were both at the instrument level. Where do we think the drop-off in modelability really takes place? What's going to pass and what's going to fail? And it was also thematic. What's going on with the industry? What are the key characteristics that we see in the data? And 2 of the areas which we found really interesting, I'll touch on now. So the first one is with the process of collecting data and trying to demonstrate the fact that you pass the NMRF requirements, you're probably going to combine multiple data sets together. And in the process of doing so, you might end up with duplicates. There's no way you can guarantee, unless you had all the attributes, that your data is completely clean. And so in this respect, one of the key things for us to test is how do we remove those duplicates in a way that doesn't impact the quality of the data set. So we ran a very simple test. We took our data, we removed every example for a given instrument where we saw more than one observation on a given day. So if we saw 20 or 30 or 40 observations on a day, we just were left with one. And that means for liquid instruments, we took out an awful lot of data, and for liquid instruments, we took out very, very little data. And the key question instead is, what does that do to our ability to pass this compliance test? And that's where it gets really interesting. Even though we took out an awful lot of the data, it had no negative impact on our ability to pass the test. Absolutely none. So there wasn't a scenario where we saw removing that data reduce the model ability. And the key reason for that is, it's not the number of observations you have that determines whether you pass. It's the number of days in which you have observations. And so the more days in which you have observations, the more you are to pass the compliance test. So the first one is removal of duplicates isn't as difficult as you'd expect. And the second area which we thought was really interesting was seasonality. So with a lot of firms, they're very concerned with during holiday periods, instruments trade less. And it's not surprising. You come to Christmas, what happens? People go on holiday. You come to summer holidays, people go away. It's really easy to expect or to identify that trading activity is less frequent during certain times of the year. And again, when we looked at it, we were really surprised. We didn't see big drops in the level of activity in December. We didn't see big drops in the level of activity in July and August, which is what we expected. We saw some evidence of it, but it wasn't as pronounced. And that seemed really suspicious to us, and we couldn't quite believe the result. So we went back and we looked at the data on a day-by-day basis. And when we looked at it day by day, we saw some really, really big impacts. No one trades at Christmas. No one's there, everyone's gone home. No one trades at Easter. No one trades 4th of July. There's key periods where no one trades. But it's not for a whole month no one trades. People trade in December. People just don't trade during Christmas. And so the impact is actually much, much less severe than you would expect. So the impact on modelability is much, much more moderated. So my key message for people who are designing NMRF solutions would be really take a look at the data. The data will tell you an awful lot about what is going to pass and what is going to fail as a compliance test. And actually your hypothesis might be based on really, really sensible logic, may not play out in reality.
And finally, with a view to a holistic approach to regulatory compliance, what synergies are we seeing with MiFID II and indeed other regulations?
So this is a really, really interesting question, especially given MiFID II has just gone live. So as any institution looks to have an effective regulatory response, an effective return on their investment, the key question is, once you've invested in a regulation like MiFID II, how else can you use that investment to your benefit? And here it's a relatively simple and straightforward link between FRTB and MiFID II. So one of the key elements of MiFID II is the requirement for post-trade transparency. So whether you are trading in a cash equity, as in the case under MiFID I, or a bond or a derivative, there is now an obligation for post-trade transparency. And so this means that the price, the volume, and the details of the transaction need to be recorded and published. And it needs to be made public to anyone who wants it. So even if you're not in financial markets, that information needs to be available to you. And it's that key requirement that is critical, because then if you come back to FRTB, for the non-modelable risk factor requirements, it asks for executed trades and committed quotes. And so the key challenge here is to get the breadth and the depth of data you need, and then MiFID II can act as that source. So for any firm that's invested in MiFID II, the ability to then use that data that's being published under MiFID II as part of your FRTB response gives you access to a really good source of data which wasn't available before. And it's not just limited to MiFID II. If we take other examples of key regulations, in the US you have TRACE, which provides information around bond trades. You have Dodd-Frank, you have the SDR reporting requirements, which provide information around derivatives trades. And actually using that information may be able to provide a significant amount of data points that help you pass some modelability tests.